Hello everyone. For those of you who don't know me, I'm Kerry Daly. I'm the manager of the Camberwell Centre Traders Association, and I represent the retail and professional service businesses across Camberwell Junction. So first, a very warm welcome to you all. I've missed seeing some of your faces as we would normally do at our business forums and the business club. And hopefully we'll get back to that soon. We'll be able to see each other in person and perhaps enjoy some wine and nibbles together as well. So obviously we've been unable to run our seminars this year, but we've been posting on our website, both camberwellshopping.com.au and camberwellbusiness.com.au, the various webinars that Burundara Council have been running, and we've managed to get a few through Business Victoria and the Small Business Commissioner. So take a look if you get a chance. There's some great topics up there. Now, just a bit of housekeeping. You're welcome to ask questions throughout the presentation. You'll probably find a little Q&A button on your screen somewhere, and you can jot down your questions. If somebody's already asked a question that you would have liked to ask yourself, you can upload it, you can push it up, upvote it, I beg your pardon, upvote it, so this we'll know it's a popular one. We make sure we address it. And if you're having any trouble with your functionality, you might be able to talk to us through chat, or try logging off and logging on again. And if all else fails, we are actually recording the session, and we'll be sending you a link in the next couple of days so that you can view it again, or at another time. So our topic today, how to bounce back in the new COVID normal world after lockdown. So it's pretty timely as we come out of our lockdown and face the reality of what our new world's going to look like. I know I've spoken to many of our traders who are really struggling to deal with the impact this crisis has had on their businesses. And I've been really worried about their mental health. But I've also been impressed about how many of them have been able to pivot their business and adapt to new circumstances. And I'm also optimistic about the bounce back that will come as our customers are able to return to everyday shopping and take the opportunity to catch up on appointments and services that they've had to put on hold. But to share with us more of his expert opinion on how we can best navigate our way out of this, I would like to introduce our speaker, Shane McKenna from the Aintree Group. Now, Shane is the director of Aintree Group and a chartered accountant for the past 27 years. And he started Aintree Group back in 2005 with his wife, Andrea, to build a firm where clients had access to long-term support backed by quality business advice. So not just accounting and tax services. They do specialise though in tax and strategic financial planning, business and management consulting, managerial finance, and succession planning. So Shane is also passionate about helping fellow business owners succeed in their goals. And Aintree are located in Camberwell Junction and are very invested in our business community. Chelsea Carter, who works at Aintree, looks after their business events, and she's a regular at our business club, so many of you know her. And Shane has also spoken there and managed to make what can sometimes be dry topics both interesting and engaging. So I'm sure he's going to do that again today, and I'll hand you over now to Shane McKenna. Thanks, Shane. Over to you.
Thank you. Thanks, Kerry, very much. So welcome everyone. I'm just sharing my screen. Hopefully you can now see the presentation for tonight. So this is talking about business planning during and beyond COVID-19. So really appreciate everyone's attendance tonight and giving up your time for this in this COVID environment. And it certainly has been a challenging time for everyone. But I was saying to Kerry just before this, I'm an optimistic person, and like Kerry, I'm very optimistic about what the future holds in terms of the economy and being able to bounce back from this. So what I'll try and do tonight is give you some overviews of some of the basic information that's out there at the moment regarding what you can get in terms of government incentive support, etc. And then also look at some key business metrics about what you need to do with your business going forward to make sure that you're ready for when things turn, when we come out of this COVID environment and the economy starts to grow again, and making sure your business is best placed to be able to take advantage of that. So I'll get stuck into my presentation, and as Kerry said too, if you've got any questions along the way, please jump in, and then there'll be question and answers at the end of the session as well. So let's get into it. So that's just, as Kerry just introduced me, a bit of spiel about me and Aintree Group, and I'm actually a local as well. I live in Camberwell too. So this is it's very important from my perspective too, that we as a community support each other as much as we can during this time, and as I said, when we come out of it. So let's get going. In terms of general advice, disclaimer, I've got to always say this, that this is general in nature what we're going to talk about today. It's not specific advice to your particular circumstances. So if there's anything that you get out of this, make sure that it is relevant to you, and make sure you get independent advice on this to ensure that it is relevant to you and will suit your purposes. So as I said, general in nature, but happy to give further advice on this down the track if you wanted to. So part one, business planning during COVID-19. So what I'm going to do quickly is just go through the tax rates currently as they are, and I'll shed some light on that in terms of the context of the budget that's coming up next week. Asset write-offs, so some support from a tax perspective, and also the government assistance that's available. And a lot of you are aware of all these things already, but I thought it's just good to have a quick refresher on it, just to see where we're at the moment, so that then you've got that information at hand so you can make proper decisions in terms of what you want to do in terms of investing or buying assets, etc., going forward. So the individual tax rates, now these are for the current year. So you'll see that there's the bands. I'm not going to go into detail. The key thing to note with this is that we've got a budget handed down next week, and there has been a lot of talk, and it seems almost certain that we will have tax cuts presented to us, which will be brought forward. Originally, these tax cuts were meant to happen in a couple of years' time, but based on COVID-19, they're looking at bringing forward the first round at least of these tax cuts. And the key thing in this schedule that will change is the band between 18,000 and 37,000. That looks like increasing to 45,000 before that, for that 19% tax rate. And then the other one is the band between 37,000 and 90,000. That tax rate will stay the same, but they're looking at extending that now to 120,000 worth of taxable income. So they're the two key things that they're most likely here on budget night next week. They're not certain, but there's a good chance. And then there's a second round of tax cuts they're proposing, which will happen a few years further down the track, 2025, which they again may bring forward. And that will change some of these rates quite significantly, where they'll actually abolish most of the brackets here, and they'll bring it back down to 3, where you can pretty much earn between 45,000 or 50 is what they're proposing, 50,000 and 200,000, and pay a flat rate of tax of 32.5%. So that's something just to be aware of, and it's not very exciting sessions generally, the budget. It is for us accountants. I really enjoy watching the budget and what they present, but it's really important. There's a lot of things that will be coming out of that budget, and I'll talk a bit further about that as we go along as well. Similarly with the company tax rate. So the company tax rate for the current financial year, that has dropped for small businesses. Now, small business turnover less than 50 million. I think that's probably more than just small businesses, but up to $50 million worth of turnover, the company tax rate has dropped from 27.5% to 26%. If you've got a large business over 50 million, then that tax rate is 30%. Again, there is talk about them bringing that tax rate, because there was a proposal to stagger that down to 25% into the future. And there is speculation that they will also look at reducing that 26% tax rate down to 25%. Now, when that'll be effective, who knows? It could be straight away, immediately, and therefore it'll come into the current financial year. They may start it from 1 January. We'll just have to wait and see. But things really important to note is that the government is looking at giving tax relief to small businesses through the company tax rate for individuals, or sole traders through the individual tax rates. The key thing for us as a community and business owners is that those tax cuts are then spent in the economy. We really need that to stimulate the economy. So hopefully people just don't take those tax cuts and then save them. And there's been anecdotal evidence in the US recently where that's what the majority of people did when they got your tax cuts in the US. So we really need that money to be spent within the economy to stimulate growth within the economy. So we all have to try and do our part in that respect. Other things that are available at the moment, so there's what's called an instant asset write-off, and you've probably heard about this one too. So that was announced in March 2020, that if you purchase an asset up to a maximum of 150,000 for that one particular asset, so each asset, then you can get an immediate tax deduction for that if your turnover is less than $500 million. So that's quite a significant benefit if you can take advantage of it. Now, again, it requires cash flow, it requires finance potentially. So you've got to make sure that it fits within the context of your cash flow, but that's certainly something that can, again, help you with your business in terms of getting some tax relief. So that's out until 31st of December this year. Again, speculation, I can't confirm it, but it's most likely that the government will extend that in the budget next week to extend it beyond the 31st of December. So it gives you that ability to invest in assets up to 150,000. If they don't extend that, then what happens on 1 January is that drops down to $1,000. So it's quite a significant drop. And what that means is that, yes, if you've got the opportunity to buy something before 31 December, then this is an option for you. But I would hold out until we hear what gets announced in the budget next week to see whether they extend that. The key thing with this one, just to note, is it must be installed ready for use. So if you buy that car that you need for business purposes, so the ute or whatever it might be, the delivery van, and then you don't receive delivery of that until after 31 December, as the law stands at the moment, then you won't get that immediate tax deduction because your van is not available ready for use. Even though you might have an invoice before 31 December, it's not available for use, and therefore you cannot get that tax deduction. It will then fall into the next category, which is below, which is the accelerated depreciation. And that allows you to, if you don't qualify for the instant asset write-off above, to depreciate that asset in a speedy way, and sorry the terminology, but it means that you can depreciate up to 57% of the asset on purchase in the year one, and then you can depreciate it on normal terms beyond that date. So that's available to, if you don't meet that 31 December criteria and you've got an asset, say you purchase in January, then you can use that accelerated depreciation rule to be able to get that tax deduction, or a substantial part of it, not all of it, but a substantial part of it in the next in this financial year. Government assistance, there's been lots of news about this. I'm not going to go into a lot of detail on this because I think we're probably, well, I've been dealing with this for the last 4, 5, 6 months with our clients. Cash flow boost, which is to do with getting a cash payment from the government if you employ staff. You would have seen, if you qualify under this criteria, you would have seen those payments coming into your bank account from your business when you've lodged business activity statements over the last few months. That phases out at the end of this month, the cash flow boost. So you should, if you qualified, you'll get your last payment in the September BAS. So that's something to be aware of. Now, it's tax-free, so that's a really good thing. But depending on how you're structured, there could be a sting in the tail. And if anyone is interested in how that might work when we get to the Q&A at the end, because I can go into detail now, but it'll take a little bit of time. But that's one where it might be tax-free on the surface, but if you're in a company, it might have a different tax treatment ultimately when you take that money out of the business. So, but that's available to people, and you should have got that by now and should be getting that until, as I said, the end of September. And then we've got JobKeeper, and we're up to JobKeeper 2.0, maybe even JobKeeper 2.1 with some of the modifications, but that's now in play. That came in effect yesterday, the 28th of September, for the payroll that you pay your employees from the 28th of September to the 3rd of January. And then there's a further extension of that from the 3rd of January till the 28th of March, which is on a different payment arrangement. So when you look at this scenario from the 28th of September, you get $1,200 per fortnight for each eligible employee who's working more than 20 hours per week, and $750 per fortnight for any eligible employee or business participant who works less than 20 hours per week. So we've now got this distinction. In JobKeeper 1, we didn't have that distinction between part-time and full-time employees, or this 20-hour plus, 20-hour minus criteria, but they've brought that in for the current JobKeeper 2.0. They've also changed the income testing rules. So comparing your income for the September quarter compared to the same period last year, they've changed those rules, and that's why there's been new decline in turnover tests, which I stipulate down there on the bottom. I'm not going to go into the detail because it is very complicated, but again, if you've got any questions about that, I'll try and answer them as quickly as possible at the end of the session, or if you've got a question, please post it on the Q&A now, and I'll try and get to it when I can. But really important for businesses too, to make sure that they do qualify. And if you haven't done it yet, you need to make sure you're registering it for it. And then if you're not sure about anything in it, because it is complicated, then you need to engage a professional such as your accountant to help you with that. But they should be on the front foot, and they should be giving you information about this now, so you can plan and make sure that you get your application in and claim that JobKeeper as soon as you possibly can, because that is immediate cash flow to your business and very important for you to sustain the employees going forward. Then there's also, sorry, just flip that too. There's also the Business Support Fund, third round, which is the Victorian Business Support Fund. This opened up Friday before last, and this is under their ongoing support packages to provide, again, support to Victorian businesses. And you'll see here just a quick rundown of that one is the grant depends on the business annual payroll. So if you've got payroll of less than 650,000, you get $10,000. If it's between 650,000 and 3 million, you get 15,000. And then if your payroll's between 3 million and 10 million, you get $20,000 as a payment from the government. But there's eligibility criteria with that too. So including that you need to be in the JobKeeper scheme. So again, check to make sure you qualify. You can go online and do it yourself, or again, if you need assistance with it, then seek advice from your advisor, your accountant, whoever it might be, to help you with that. But you just need to make sure you qualify under those certain criteria. So it's really important that we look at all these assistance packages and make sure we're getting the benefits of those that we can to help our business get through this very difficult time. And then as things ease up and we start to get more activity in in the economy, then hopefully then you're well placed to be able to then bounce back and get through and have a prosperous 2021. Yes, there is grants for, I've just had a question about the fact that this is for businesses that have staff. There is also payment incentives for, and I've just got it in the next slide, on payment incentives for sole traders as well. Unfortunately, in most of these incentives or as government assistance packages, sole traders have been hard done by, is I suppose all I can say, where they have missed out on a lot of the support packages. There is this one for sole traders that the government has released, but again, there's certain criteria around it that you need to make sure you meet before you can qualify for it. And then also you have to be in it, and both with this sole traders and also with businesses, you also have to meet one of the ANZIC codes. So what there is what's called an ANZIC code, which is your industry that you're in, which is on your ABN. You need to meet or be one of the listed businesses with an ANZIC code that's listed on that schedule from the Victorian government to be able to qualify for this support, be the $3,000 for sole traders or up to $20,000 for businesses. There's also waivers and deferrals that are available where you can defer payroll tax. So if your payroll's over $650,000, generally you're liable for payroll tax. You can get some benefits of deferrals on that. There's also liquor license fee waivers, which are very important. There's also a program called Click for Vic. And again, for those retailers or food providers, etc., look at Click for Vic and see whether you can list your goods and your services on there, because that might be another way in which you can use a different avenue to basically promote your business and get further sales for your business. And then there's also business chambers, trade groups that have got support packages as well. So you really just got to be on top of this. Have a look in your local media, have a look in your local council website, look on the Victorian government website to get details about what support is actually available for you. So really important that you do look into this because a lot of these are very simple to actually apply for and get that money, and it's very prompt. We've had clients who've applied for the grants from the Victorian government, and it's 5 to 7 days before they've got the money after they've done the application. So they are getting through the applications very quickly at the moment. As I said before, just look at your local government support grants as well. So look at the Burundara. Burundara actually had one until yesterday, it finished yesterday. Would have been good to be able to tell you that, but there was some small business grants they're offering up until yesterday, so that's now closed. But again, just keep up to date with things. Tap into the Camberwell Business Group as well, the association, and I'm sure they're doing a great job, or they are doing a great job giving that information out to make sure that people are aware of what's out there. So that gives a brief overview of what the support is at the moment. But the really important thing, I think, is about looking forward. No point looking back. We can't change what's happened. It's been a difficult time for everyone, but we've really got to start looking forward and preparing our business for what's to come next. And with our clients, we have a lot of conversations about making sure that their business is set up for success in the future. And that can encompass a number of different areas. And what I'm going to do now is going to go through some of the key business metrics that we look at and the business improvement strategies that you can employ to make sure that your business is ready and is doing everything it can to succeed going forward. So if I just flick to the next slide, and I'll just go through some general comments about when you're running a business. And I've been an accountant for 27 years, and I see a lot of businesses who are successful because they plan and because they really take an interest in their financial metrics, and they really take an interest in making sure that the business is efficient and they've got all the information available to make proper decisions. Those that don't plan are obviously more likely to fail. And so we have regular conversations with our clients about the things that they should be looking at to make sure their business is successful. So just quickly going through some of the main key items that we talk about. Obviously, financial statements are really important. Most people run an accounting system which is very efficient in generating profit and loss and balance sheets and so on. So it's really important that you actually make sure you've got good quality financial statements and that they are prepared regularly. So what I'm saying is most useful when they're prepared regularly. So really you should be looking at your financial performance of your business at least monthly. Don't leave it to quarterly. Don't leave it to year end. It should really be done at least monthly. And even you should be looking at your performance of your business on a weekly basis. And there's a lot of tools that you can use to be able to do that. And I'll touch on that a little bit later in the presentation. But really important that you look at your financial statements and make sure that they're prepared regularly. And that just doesn't mean coding the cash book or the cash transaction or anything. It's actually looking at the total picture. So, and again, I'll go into this a little bit further, but looking at making sure that things are reconciled properly and that you've got proper information within those financial statements. And again, I see a lot of circumstances where people are preparing regular profit and loss and balance sheets and so on, but there's lots of errors or things that are not reconciled correctly in there, such as fixed assets, such as debtors or creditors or whatever it might be. And therefore the information that they're getting may not be relevant or may not be accurate. And therefore it makes it difficult to make proper decisions with that information. For instance, looking at, and I've said it here, looking at budgeting. So making sure you've got projections about where you want to be or what you're aiming to do in terms of the business. So budgeting for what expenses you know you need to incur. Look at the cash flow, because profit and loss is different to cash flow. So don't think that, oh, I'm making a large profit, therefore my cash must be good, because that's not always the case. And again, I'll demonstrate that a little bit later with one of the slides that I'll present to you. And then, as I said, projections, setting targets for where you want to get to in terms of sales, profitability, cash flow. It's really important that you set targets for yourself. So you've got something to aspire to, and then you can then benchmark yourself against those to ensure that you can then make proper decisions, and then you can react to things and change things as you need to. Did anyone prepare for COVID-19? Absolutely not. But if we've got timely and up-to-date information, then that allows us to make decisions quicker, and therefore we can adapt and change the business and the direction we might be heading in if we've got that timely information where we can make properly informed decisions. So that means, as I said before, monitoring and making sure that you're planning for things that may come up in the future. So, apologies. So, and that applies to any business structure you may have too. So there might be sole traders, partnerships, trust companies. It doesn't matter which structure you operate through. It's really important that you do the proper monitoring and planning for your business because, as I said, most businesses who plan properly, they have the right information in front of them. They're the more successful client businesses than those that don't. So this just gives you a quick overview. I'm not going to go into this in detail, but this gives you an overview of the cycle of planning and monitoring. So first of all, do you have a business plan? When I ask that question to a lot of clients and businesses, the answer is generally no. Or they've got one, but they haven't looked at it for 10 years. And my question is why? What's the relevance of it if it's just put in the drawer? So have a look at it. Look at your strengths, opportunities, threats, etc. The SWOT analysis. Look at the projections or the what am I trying to say? What your mantra is or what your vision is for the business. Is it still relevant? Do you need to adapt and change that vision because of the circumstance that we're in today? Do you prepare, as I said before, financial budgets? So every year you should be preparing a budget for the business. And then, as I said before as well, do you prepare monthly management accounts? So again, you should be getting that information on a regular basis so you can make proper decisions. So for instance, if you see that your purchases or cost of goods sold has gone up dramatically from one month to the next, if you've got that information, say 3 days, 5 days, 7 days after the end of the month, then you can make some decisions about that. Whereas if you leave that to the end of the quarter or the end of the year, it's probably too late. And it's then you've lost substantial, you've incurred losses or you've made less money because you haven't made those decisions quickly. So it's really important that you do that planning. And I really stress that even for a small business, no matter how big or small, it is really important that you do that planning and you compare actual performance against budgets and forecasts to make sure that your business is on the trajectory and on the path that you want it to be. And as I said, you can then make decisions and adapt that if it's not the case, and then seek advice if you need assistance with that plan as well. So when you analyse your financial statements, they give obviously an overview for the 12 months or monthly, depending on which ones you prepare or look at. But they're a historical analysis of what you've done in the past. But they can be very useful for about what you need to do in the future, because you can then see trends and other things with those reports. So you normally get a profit and loss in the balance sheet. Very rarely do people prepare cash flow statements, but again, with software now, that should be generally pretty easy to generate a cash flow statement out of your software to see what your ins and outs are from a cash flow point of view. Because as I said before, profit and loss and cash aren't the same. And you might have a wonderful profit, but you may have no cash. And you're thinking, why? What's going on? And again, I'll touch on that a little bit later about how that can be the case. And then who uses the financial statements? Investors, obviously, employees, potentially lenders, and suppliers and trade creditors. Now, back to lenders. So in this time, you might need to raise finance or get equipment finance or something like that. Having those financial statements prepared on a regular basis and in a current basis means that then the lenders will have more confidence in your financial affairs to then potentially give you that lending and make the whole process much more efficient. So it's really important that you prepare them on a correct basis and then make them available to whoever may need them. So it's really important that you analyse them and then use them as a tool going forward. And as I said before, so some of this is a bit repetitive, but yeah, so produce them at the end of each month is my recommendation as an absolute minimum. So for my business, I know I'm an accountant, but for my business, we sit down as the partners. I've got 2 other business partners in my business, and we sit down on the 7th of each month and we go through the last month's financial report. So the profit and loss, balance sheet, cash flow, cash position, we go through our debtors, we go through our all the other metrics that we have within the business, and we do that every month without fail. And you should always do that. They should also not be cash driven. So a lot of clients may not take into consideration their debtors, their creditors, or their stock when they're doing their financial reports. If they don't, they're not going to tell you that they don't mean much at all. Yes, the good analysis of what your cash position is, but it doesn't show you what the true position of the business is. So again, you've got to make sure that they're done on a correct basis, and then also don't do them just for tax return purposes. Don't prepare tax accounts, because again, that doesn't mean anything if there's substantial things that you're leaving out of those financial statements because it's not relevant for tax purposes. So again, we always encourage people to prepare them correctly. Engage a good bookkeeper or an accountant to help you with that, so that they are prepared in an accurate fashion, and then they're prepared on a timely basis so you can get that information very quickly after the end of each month. So really important. And if you've got those issues above, which I've just said, ask yourself these questions. If you answer yes to any of those, then you need to demand from your accountant, your bookkeeper, or if you do it yourself, you need to make sure that you're getting those timely, accurate and decent, accurate financial statements. And then what you do with those financial statements is you look for comparisons and trends. And as I said, they're historical reports, but they give a good analysis of the trends. So again, what you can do, and as an example, is you can do profit and loss per month, and then you can see the trends in your sales, your cost of goods sold, your wages, your expenses, whatever it might be. So by looking at reports on a timely basis and then having regular interval reporting means you can then identify trends with your business. And again, you can react to them. So that might be where you compare the results from the previous year's activities. You might also want to benchmark those against industry averages, and we do that for our clients too. So we look at whatever interest it might be, and then we've got data that we can then compare how you're tracking against the industry. And we might, for instance, we do this with a number of our cafes where we see what their wages are, a percentage of their turnover, and then we benchmark that against industry averages. And then we can say to them, look, your wages are too high compared to the industry average, or is there a reason why that's the case? And then if you can justify it, great, but then that gives you an idea about what you may be able to do to basically try and get towards the industry average and even better them. And that's what we like to see, try and improve beyond what the industry averages are. You can also compare results to competitors. And then also absolute standards. So there's key metrics that might be just absolute standards about doing, for instance, gross profit margin within a certain industry, or what else it might be, where generally rent should be a percentage of your total sales. So there's things like that you can also look at as well. And I'll show you some examples of this in a second. So you can actually not see all the text and actually see some numbers on the screen and how that works in a bit more visual. But what areas should you analyze? And as I said before, so you look at sales, compare that to budget. How did you do? Look at your pricing. And I've got a really good tool, which I'll show you in a minute, about pricing, what the effect of increase in prices has on your revenue. How does that compare to an increase in volume? So increase in sales versus increase in volume. How many customers do you have? What's the average sale per customer? So that's another one that's really important. Interesting thing just on that, I was reading an article, I think it was last night actually, on value of transaction per customer. In the laptop industry, and I know this is not relevant to us, but just to give you a perspective, Apple has a 7% market share of the laptop industry compared to Lenovo, who has 24% market share. The revenue of Lenovo and the revenue of Apple are about the same. So even though Apple has less than 1/3 the volume that Lenovo has, their actual revenue, so in effect their revenue per unit, is so much higher that they can generate the same amount of revenue as what Lenovo can, and I'm guessing, and I think it's pretty clear, a much higher profit from that as well. So it's about looking at your products, and I'll go on this in a minute, and identifying those that are high margin versus low margin, those that are fast moving, that are slow moving, etc. And what impact does that have on your business? Looking at expenses. So what any unusual expenses you may have. So looking at those as well and addressing those issues. So let's say you have a spike in printing costs. Is there a particular reason for that? Is it because you're rebranding or otherwise, or is it because there's been an increase in price for that particular expense that you're incurring? So having a look at all those sort of things is really critical as well. Profitability. How profitable is the business? That's very important. Similarly, cash flow. How's the cash flow been impacted? So again, as I've said a number of times already, profitability does not equate to cash flow. And so what things can affect either of those two drivers of the business? So it's really important that you look at all these different metrics. So here's an example of some metrics that we look at for our clients. And this is one where we've got some software, we input the numbers in for the client and we can see some trends. So there's a profitability trend. So you can see the different years that we've got here. And this is an example client that we've got. I've obviously taken their name out so you can't see who it is, but it shows what their gross margin has been for the last 3 years. So that's for 18, 19 and 20. And then what their operating profit is, and then what their net profit is. So it looks fairly consistent. So in that respect, that's looking pretty good. Although there has been a dip in the net profit for the current year compared to the previous year. And there's also, that's been reflective on the fact that the gross margin has dropped as well. So that suggests to me that there's been an increase in the cost of goods sold. So when you look at the next part of this, you'll see that you've got the two tabs there. So for the 2019 year, revenue grew by 1.9% and cost of goods sold actually went down by 2.4%. And then in 2020, sorry, just bear with me a sec. In 2020, revenue has gone up by 11%, but cost of goods sold has gone up by 12.7%. So again, that's a reflection on the fact that there might have been price increases in the cost of goods sold, but we haven't been able to pass those on to the customer, or we have just not done the modelling and the number crunching to be able to pass that on to the customer. Or similarly, it might be that you've had to reduce your prices because trading might have been a bit more difficult, and your cost of goods sold has remained the same. Or, so there's all these different myriad of things that could be the case, but it's really good to know what these drivers of the business are and how they could be impacted, how they impact on the profitability, so we can then make decisions on that and adjust the business accordingly. Go into some ratios. So, and again, a lot of ratios here, and I apologize for overwhelming them, but these are some examples of some ratios that we look at. So you can see revenue for this client has has increased by 133,000 for the year, which has been a 9.9% increase in revenue. The gross margin has increased, which are in dollar value, but in gross margin percentage, it's actually dropped. It's gone from 45 down to 44. The overhead expenses, now this is a really important one in this respect. The overheads have gone up from 349,000 up to 407. So a $57,000 increase and a 1.39% increase overall based on sales. So then we should look at what's driving that. So then we need to look at our overhead expenses and go through that and drill down to see what's causing that. Can we make some changes there? Can we look at buying a particular service better from another provider, such as electricity, telephone, whatever it might be, software provider, etc. So it really gives you that ability to look at those numbers and say, right, I need to do something about this. What can I do? Let's have a look at the information. Let's look at our timely prepared financial reports so I can make some decisions on this quickly, so I can then turn this around. And then you can see in this case, the profit has dropped by $7,000 or 2.2%. So really important that we look at these numbers and we then, from those numbers, then create an action plan of things we need to look at. So here's some more, and some really important ones. So accounts receivable days or debtor days. So you see in this case, they've actually increased on average from 42 days to collect to 54 days. So that's a blowout of 12 days on the accounts receivable. Similarly, inventory days have blown out too. We've gone from 95 days to 108 days. So again, what strategies do we look at employing to try and analyze that and then try and improve on it? Accounts payable days, that's improved, or it's gone out, it's extended as well, which is it's increased, but that's a positive thing on cash flow. But again, we've got to be conscious that we're not going to disenfranchise our suppliers because we're extending payment terms too long, where they come to the point where they say, look, we're not going to supply you anymore, and that then creates other issues. But the key one in this one, based on all those things above, is the working capital days. And what that means is that it's increased from 60 days working capital that you need to keep in the business to 84 days of working capital. So it's increased by 24 days. And what that means is that's from the day when you make the purchase of the goods to the day you receive the cash from the customer. That is your working capital days. And that is quite substantial in this case where it's blown out. So that is a concern, and that would be a red flag for me when I'm looking at this client's business, to then come up with, talk about the strategies that we can adopt to try and improve on that, to bring it back to the 60 days and even try and improve on that to get it even lower. And you can see the amount of money that actually equates to. It means that they need to invest their own money. $173,000 in working capital was up until 30 June 2019, but that's blown out to $263,000. So they've had to leave or contribute nearly $90,000 into this business to be able to sustain the business for that 12 months. And that's got to come out of their pocket. It's got to come from the bank, or it means it's profits that they leave in the business that they're reinvesting because they can't take it out for their own living expenses, etc. And then the other one too is that then we look at that on a per $100 basis, and it's saying that you need $19 for every $100 of working capital. So for every $100 worth of sale, you need $19 worth of working capital. So 1/5 of the sale you need to leave in the business for working capital. And again, we can look at strategy to improve that, but you can see that that's blown out as well in this situation. So again, prompts us to have a look at these numbers, look beyond the numbers and work out what's causing that, and then having that conversation with the client to try and improve it. Marginal cash flow is another one where it's basically got free cash that's coming out of the business. I'm not going to go into that much detail, but that's a combination of the working capital turnover and the working capital per 100. And then you've got the current asset ratio, which is your current assets over your current liabilities. Now, the reason why that's probably increased and is a positive is because the debtors and the inventory is blown out higher than what the accounts payable has. Current assets is generally your cash, accounts receivable, inventory days, less your purchases, creditors, GST, etc. Those things that you would pay for, receive and pay for in the next 12 months. So that gives you a good idea about how the business is performing. And as I said, all the red marks are there. We need to look at and ask, why is that happening? What do we need to try and fix those? And this is where we get to a really, I think it's a cool tool, and you might think I'm a bit sad saying that, but I think it's a really positive tool that we have that we use with our clients. And it's called the Power of One. And what we can do here is we can basically see what the impact of different changes in our business can have on the business, on the profitability and the cash flow. So for instance, you can see here that I've got a 1%, 1% for the price increase, volume increase, cost of goods sold reduction, overhead reduction, and then we've got number of days for reduction in accounts receivable, inventory, accounts payable, and then what impact that would have on the business. And so this is just a template one where I'm showing you if we did 1% for each of those or 1 day for each of those. So if we were able to, and I know this is easier said than done, if we were able to increase our price by 1% on all our goods, what impact would that have on cash flow? And what impact would that have on our operating profit? Now you can see above that our net cash flow for the year is minus $4,915, but our profit is $197,000. So there's quite a big difference between those. But if we did a 1% increase in price overall across the board, then this is what would happen. We would improve our cash flow by $11,000 for the year, and we'd increase our profit by $13,000 for the year. Similarly with the cost of goods sold. With volume increase. If we decide, no, look, we can't do our price increase, but we can increase our volume at the same price, what impact would that have? And you can see that the volume increase would be $3,417 impact on cash flow and $6,000 impact on profit. Now, the key thing I want to stress between those two comparisons is you can see quite clearly the impact of price increase versus volume increase. That the price increase is has over 3 times the impact from a cash flow point of view than what a volume increase does. And from a profitability point of view, it has over a 2-time improvement in profit compared to for a price increase compared to a volume increase. So really critical that we understand the dynamics and how that impacts the business. Now, as I said, it's easier said than done to increase your price by 1%. And particularly in this climate, it's probably very difficult. But similarly, you've got to be aware that that is a better strategy potentially than volume increase. Similarly, you'll see what the impact is on cost of goods sold reduction. A 1% reduction means a positive impact of $8,000 on cash flow and a positive impact of $7,400 on profit. So again, you can see that a cost of goods sold reduction has a better impact, a more positive impact than a volume increase in this client scenario. So again, that's something you should focus on first. So it's about prioritizing these metrics to see which one is more achievable than the others. If you can do all of them, great, but then focus on the ones that you think are more achievable and then see if we can get a positive outcome from those. Overhead reductions, again, if you can reduce your overheads by 1%, then that's a better impact than the volume increase of 1%. Reduction in inventory days, reduce it by 1 day. Remember we looked at that slide before that it had the inventory days at 108? If we can get that back down by 1 day, that's a $2,000 impact on cash flow because we're not having to put as much money into working capital. If we go back to this slide, 13 days, if we can get it back to what we were last year, 13 days times 2,000 works out to a $26,000 impact on cash flow. Suddenly, the business is back in a positive cash flow position for the year. Really important too, that this inventory days, again, looking at the previous one, accounts receivable, it's blown out to 54 days. If we can get it back to 42 days, which is 12-day reduction, and again, I can talk about strategies in that respect, then 12 times 37, $3,700, excuse me, that's about $45,000 in cash flow positive. Again, has a major impact on the business and the major impact on the cash flow. So it's really important that you understand how these different performance indicators have an impact on the business. And if you can do things to basically improve on these, then you can see quite clearly that it has a major impact and a major improvement. It can give you a major improvement on your business. So it's about working through those strategies, the strategies that are behind these numbers to work out what you can do. As an example, inventory days. Look at, as I said before, look at slow moving stock. What stock has been sitting on your shelves for too long? Can we get rid of that and not buy that in the future? And that will then help our inventory days. It'll also free up cash that's sitting on the shelf in stock that's unsold. Also look at the margins on those goods. What inventory items are providing the best margin for your business? Can we focus on those and look at those that are not providing a good margin? And again, look at removing those or not selling those into the future. So selling them out now and then not repurchasing those inventory, that inventory. So it's really important that you've got good control systems and good reporting systems to be able to have a look at that inventory, to be able to make that analysis. With your accounts receivable days, are there particular clients that are causing the debtor days to blow out? Look at your debtors listing. Look at the aging of those clients. Look at reports behind that to see how quickly certain clients are paying. And then you could then basically stop credit for certain clients if they're not paying you promptly enough, or you can have a discussion with them about the fact that they need to improve their payment terms to you, or you might stop supply to them. So again, it's looking at those things behind it to give you strategies to basically improve your business. Just keep going through. This one's a really important one. With COVID-19, we've seen a lot of clients where they might have had a lot of working capital in their business because they've been trading and they've been repurchasing stock and everything. But there's been a situation recently where there's been a bit more of a cash flow in because they've reduced their creditors or they're getting their debtors in and they're reducing their stock purchases, etc. So for a number of our clients, the cash flow has actually been okay up until now. The key thing you've got to be careful of, and this is really important when things start to ramp up again, you need to restart buying stock and start trading at a higher level than what you currently are at the moment, is that what is the cash flow requirements you need to be able to do that? What is your sustainable growth? So what I've got here is an example of what you need to be aware of when you're looking at that for your business. So if you increase your revenue by $100, and this is again filters in from the previous slides that I've given you, then the cost of goods sold for this client is $55. Then that shows the gross margin. Then there's overheads. So then your profit will be on that $100, $14.62. Then we've got other expenses, which are very small here, and I apologize for that. You've got interest paid on debt that you've got taxes paid, and then you've got dividends out to the shareholders. And that means after all those payments in this scenario, there's only $2.13 that is retained profits that can be reinvested in the business if we're doing it on this basis. But then we need to also factor in what you need to do in terms of investing in accounts receivable. As I said before, our debtor days were at 54. So on that basis, you need $14.79 worth of money invested in accounts receivable. Similarly for inventory, at the moment being 108 days, you need $16 per $100 of turnover for those. Against that, as a relief against that, you've got $11 worth of credit on accounts payable. So you need $19.45 in working capital. Don't worry about the capacity to borrow one at the moment, but in effect, if you take the retained profits less the working capital that you require, that means you have a shortfall in this scenario of $16.87. So by increasing the revenue, we're going to have to come up with additional cash resources to be able to fund that increase. And that's something that everyone has to be very careful of when we start coming out of this, to make sure that you've got that cash reserves to be able to do it. And if you don't, you're going to find that you're going to start to struggle from a cash flow point of view. Secondly, with that too, and this is really important as well, when we look at the benchmarks in terms of the cycle of cash flow for small businesses within Australia, the worst 2 months of the year are January and February, because we've got the hangover from Christmas, where you've got to pay for all your stock that you might have bought to increase your stock reserves for Christmas. We've then got a lot of tax payments due in February for business activity statements, etc. Maybe some credit card debts you need to pay as well. And so traditionally, cash flow is worst in the country in January and February. And there's a really good website you can go onto, which is from an accounting package called Xero, which is called Small Business Insights. And it gives you that tracking. You can see how it actually tracks from month to month during the year. So again, we're in this situation where we're just coming into October. It's really important that you understand that you've got to make sure you've got sufficient cash reserves to be able to ramp up your revenue again. So a lot of planning in that respect is really important, and it might require conversations with your suppliers and also conversations with your customers if they're on a credit account, to make sure that they're paying you in a timely manner. So really important. This is a really good one to take into consideration, because it's not just a matter of, I can just ramp up my revenue again. It requires cash flow. So the other key business metrics that you need to consider, as I said before, budgeting. It's really important that you've got a good understanding about what's available. So I just checked my chat. So it's just gone off my screen. Oh, sorry, Chelsea just posted a link to the Xero Small Business Insights in the chats. If you want to click on that link, you can have a look at the training for cash flow for businesses. So thanks for that, Chelsea. Yeah, budgeting is an integral part of the business. So you've got to be fully informed. You've got to make decisions now about what you're going to do in the future. So it's really important that you make sure you do your budgeting correctly. And it's basically a plan. It's a financial plan of your estimated performance. And again, I think we're all very generous when we do our budgets. We're optimistic, which is a good thing, but it doesn't mean it's set and forget. You can always go back and rejig it, recalibrate it if things change. And particularly in this environment, it's very difficult at the moment to plan appropriately, but a plan is better than no plan. So therefore, I'm still encouraging you might say, look, it's too hard at the moment because we just don't know where things are at. You still have to have a plan, because if you don't have a plan, then you're more likely to fail. If you've got a plan, at least you've got some more perspective on what the circumstances may look for you in the future. And as I said, as things start to ease up, you can then recalibrate that budget to know exactly where you'll stand at any given time, and make sure, as I said before, you've got that timely information, so that from a financial reporting point of view, so you can compare actual to budget. So really important in that respect. And then you can have different budgets. You can have divisional budgets. You can have a budget for a particular division of your business or a particular stock line. So it doesn't have to be just one overarching budget. It can be broken down into different components. And the good thing about software now, and accounting software, which I'll get to in a second, is that you can actually do that through your software quite easily. So it's using the tools that are available to you. If you're not sure about what those tools are, seek advice, because it's really important that you can use those tools to your best advantage. And as I said before, cash flow, it's the critical lifeblood of a business. As I said before, it doesn't mean it's the same as your profit and loss. And what I'll do is I'll quickly show you what that means for this client that I demonstrated before. So you'll see in this situation that the client has made an actual profit of $213,000 from trading, in effect, cash flow, but then it's got payments out to suppliers, it's got payments out, cash from customers that deteriorated for the year, etc. So the net operating cash flow without taking into consideration debtors and creditors and suppliers, etc., is 213, but the real cash flow is actually 123,000 because of those things. And then we've also got overheads that we need to, including overheads. So it's actually the profit versus the cash flow is actually $89,000 difference. And then below that, we've got then other things that we've incurred during the year. Oops, apologies. Interest paid. We've got taxes paid, which are not part of your profit and loss because it's below the line. We've got dividends that we've paid out to the owners of the business. Now, they don't take wages out of this business. They take it as dividends or distributions. And so we need to factor that in as well. That's not in the profit, but that's an expense or a cost of the business from a cash flow point of view. And then we've got all these other ins and outs based on the cash flow. So what it means is, in effect, we start from a cash operating profit of 213,000, but the reality is we've actually got a loss or a negative cash flow of $4,915 for the year. So your profit is one thing and your cash flow is another. So again, as I've stressed a number of times, it's really important that you understand the difference between the two and what are the drivers between the two, and then how you can make sure that while your profit might be good, your cash flow is also strong. And then that also helps with that previous slide I showed before regarding the sustainable growth. We want to try and improve on the debtors, the accounts receivable. We want to improve on the inventory to bring those numbers down in terms of the cash flow required, so that then the number we've got here is not a shortfall, and it actually means that the business can sustain growth without any significant contribution from the owners or from debt or whatever the case may be. So it's really working on those drivers carefully, strategically, and robustly to get the best out of your business. Also, the last thing that I'll cover tonight is about business improvement, systems and processes. So it's all good to talk about these things, but what tools can you adopt to be able to help you with this? And I've said this to a number of my clients. Now, if you've got a bit of extra time before we start to ease up restrictions, because you've got less business activity at the moment, now is the perfect time to review your internal systems and procedures. Identify the pain points in your business, identify those inefficient processes in your business, and look at ways in which you can improve those so that when things do turn, then you can reap the rewards of those efficiency gains to help you with your profitability and your cash flow. So is there a better way to do it through systemization and automation? A lot of cloud-based products now, and this is the future of where we're going. A lot of systems now are cloud-based. For instance, Aintree Group, our business, is completely cloud-based now. We don't have any desktop applications. The benefits of cloud, now there's obviously some people may have security concerns with it, but the benefits of cloud is the integration you can get between applications. And some examples I've listed here, which are some really good ones that work really well for some of our clients. You can use, for instance, Vend, which is a point of sale and inventory management system, which is online, and that connects automatically to Xero, which is your accounting system, where you can then go from the point of sale right through to the bank reconciliation, the GST reporting, and the financial reporting without a lot of touch points and a lot of manual intervention. So looking at things like that. Another one, Deputy, a really fabulous rostering and time tracking system for employees, where that can help you if you're doing a manual rostering of your employees at the moment, using an online system that can help you with that and make that more efficient. And I highly recommend Deputy in that respect. One that we use in our business as well, Chaser. So we have a lot of clients we provide 14-day credit for or otherwise. And we have a program which we bolt onto our accounting system, which we actually use Xero, which is Chaser. And what that does is it sends automatic debtor reminders a day before the account is due with a copy of the invoice and a reminder, and then also a link to a payment gateway where the client can basically click on the link, open it up, pay via credit card or direct debit or BPay. Through that one email reminder. And that system automatically then reminds the client in 7 days if they haven't paid, another 7 days, another 7 days. And it also gives us reminders too if they're not complying with with our debtor terms, so we can then follow up and make phone calls if we need to. So another really good tool that's out there that links to accounting software. There's a whole bunch of other software out there as well that is really effective. I'm not going to go into them now, but there's so many of them out there. It's about finding the ones that suit your business best. And there are business specific software out there that you can use to help you with that. But I highly recommend you look at those things to try and automate as much as you can to reduce the amount of data entry that you do and to be able to allow you to be able to generate financial reports in a much more timely basis than what you would otherwise. So you can then make proper decisions from that information that you're getting. So really important, and I don't stress enough on this one how important it is, but also looking at internal systems. So we've done that with our business too. We've looked at some of the processes we do internally, and we've spent a lot of time enhancing those so that, again, in the future, we'll get some efficiency dividends in that respect to mean that we become more efficient in the future, which means we can then get to our service our clients better. So it's all about efficiency to serve your clients better, and to basically help you in your business to make it more profitable so that then you've got more disposable income for yourself. Last thing I'll say is about top tip, and this is a blatant plug for accountants, whether it's Aintree Group or another accountant. Use your accountant properly. I see so many people that when we get new clients, so many clients we see that are not being looked after by their accountants, either because one, the accountant hasn't asked the client, or the client hasn't asked the accountant. Accountants are not just people that just do tax returns at year end and say, see you in 12 months time. They've got a wealth of experience and are there to help you with your business. So they're more than just tax advisors. So you should be demanding things from your client. You should be demanding timely attention, such as getting regular monthly or quarterly reports, but I'd suggest monthly. Having quarterly meetings with your clients. We do that a lot with our clients, and we do a lot at the moment in this COVID environment through video conferencing. We catch up with a number of clients on a monthly basis too. So we prepare their financial reports on a monthly basis. We then forward them to them, and then we have a conversation about those. So we do that regularly. So it's really important that you tap into that resource. Yes, it will cost you money, but my take is that the investment in that time and effort with the right accountant will give you a far better return on your investment than trying to do it yourself, because they've got the experience of dealing in a number of industries, dealing with a number of clients, and they are really well placed to help you through this period. But you need to make sure they can do the things that we've talked about before, that they can help you with cash flow, they can help cash flow reports, they can do this ratio analysis and margin analysis and benchmarking for you. They can give you advice on systems and procedures and how to improve on those. All I can say is don't leave it and don't think that that's a cost. It's actually an investment, and get onto it now, because you want to be as best placed as you can going forward in the next little while as we come out of the lockdown and we're moving into a COVID normal environment. So sorry for the blatant plug, but highly recommend that that's something you should look at doing. And that is pretty much it from me. Oops, sorry, apologies for that. So really, sorry, it's probably heavy, and I try to, it's probably not the most exciting topic, but hopefully you can see the importance of it. And yeah, really like to thank you for your time. If you've got any questions or answers, please, questions that you have for me, please let me know, and I'll answer them as best as I can.
Okay. James.
Yeah, I was going to say, so Shane, yeah, there's a couple of questions that have been answered. So do you have access to the Q&A?
I do. I've got it now. Yeah.
Do you want to?
I had to minimise it because I couldn't see my full screen.
That's okay. Let's make sure.
So Diane had a question with the working capital comparison. Is there a guide for what the target should be? It depends on your industry, to be honest, Diane. So we've got some benchmarks for different industries. So it's hard to tell you off the top of my head what that would be. But generally, obviously the lower the better. But again, it comes down to whether you got stock, whether you carry stock or not, whether you have debtors on account or not. So I can't say categorically there should be a benchmark that you should be able to achieve. It's subject to your industry. So if you're happy to give me details about that, I could come back to you at a later point and give you some guidance on that. And the last one, also the other one, Diane, too, about do you recommend annual budgets or extend it further, say 15 months? The longer the better for me. 12 months is a minimum again. So if you want to extend it to 15 months, I think that's a positive thing, because the longer you can prepare and project out, the better. So I think that's really important. Another question, how often should you review business plan? Depends on the circumstance. I'd say at least every year. But obviously when major events like COVID-19 come into play, I think you need to do it more regular than that. But I think you should just pull it out and have a read of it every year as a minimum. And again, recalibrate it if you need to. So I think that's really important you do that. And again, if it's sat in the drawer for 10 years, I think now is the perfect time to have a look at that again, because you want to put the time and effort into it now to actually prepare yourself for us coming out of this lockdown and the economy starting to bounce back. Another question, do you have any tips for consultant service-based businesses specifically? My main tip for service-based businesses is love your clients and do the best for your clients. Prompt responses to clients is a key thing, and that's one thing we pride ourselves on, is making sure we get back to our clients on a timely basis. Really, you still can look at debtor matters and things like that. So cash flow is still important for a consultant or a service-based business as well. So look at your debtor days. That's a really important one. Also your creditor days. But again, do budgeting. Set your forecasts or your budgets. And it's a funny one, budgets versus forecast, but set your forecast out for the next 12 months and really look at where you think your business might be in 12 months from a profitability point of view, but also a cash flow point of view. Because it's really important to know where you could be in 12 months' time, particularly if you're looking at investing in buying new equipment, or if you're looking at buying a new business or merging with another organisation. Really having that idea about where your business might be is really important. So, but definitely debtor days is one thing I would absolutely focus on. That's something we focus on with our business. So looking at strategies around how you can reduce your debtor days, whether that means changing terms to payment up front in some ways, offering a discount potentially for payment up front, doing monthly retainers, things like that could also help you. So definitely look at that as one of the options for you.
I've got a question actually as well. Sorry to just jump in by this, but on the other side of things, so if you're a business and you're heading to growth phase, and obviously cash flow is a big component of expansion and all that sort of stuff, when do you think it's sort of appropriate to be trying to grow on your own and your own resources versus trying to source external funding?
That's a good question. I suppose part of it depends on when you look at that growth plan and you do a forecast for yourself in terms of the cash flow requirements. It's obviously looking at what your cash reserves are to be able to do that.
Yep.
So that's obviously a critical one. And then if you find that your cash reserves aren't sufficient, then that's where you can look at funding. Having said that though, I'm always a fan of trying to get a good mix between your own personal funds and funding from a bank or otherwise, because you don't want to tie up all your personal resources in the business. You want to have leverage through using external funding as well. And with interest rates very low at the moment, it's a good chance to be able to do that. The only negative or the caveat I'll say on that is that currently, based on COVID-19, the lending criteria for banks is quite tough.
Yeah.
And the timeframes in getting finance from banks is very tough. I've got a client at the moment where we've been trying to get finance since April and we're still waiting because they've been inundated with other businesses seeking funding as well. And I can tell you from that client's perspective, they're a very strong business and it shouldn't be that difficult. But there's a further process that the banks are going through at the moment regarding their funding. So it's making sure you've got enough time for that. But then secondly, if you are going to banks, and I touched on this before in the presentation, it's making sure you've got up-to-date, accurate financial information. So you can present that to the bank and give them confidence. Plus a business plan, really important. Banks really love to see a business plan. So really important you've got those documents prepared, they're accurate, or they use appropriate assumptions and they're available when you make that presentation to the bank, and that will assist you in terms of that funding proposition.
Perfect, thanks.
Okay, so I think we might wrap it up there. It's a lot to cover, and I think you did it really well. Thank you, Shane, because we were able to follow some real examples, so you could see how the points we're making were relevant. So just a reminder, this is being recorded, and we'll be sending a link to be able to view this again at some point, go through it a little bit more slowly, or to share it with somebody else you need to share it with. So that's a terrific opportunity. We'll send those out in the next few days. But I just wanted to sum up by saying also that we have actually, as the Camberwell Traders Association, have got a traders portal tab on the website on camberwellshopping.com.au, and we post all the other webinars that are around at the moment. Aintree run them quite regularly. As I said, Council are running them regularly, and I know Business Victoria have got some excellent ones. Yes. And we're posting all the other resources we're aware of as well. And I know there's some grants and things that our businesses have taken advantage of, and as a Traders Association, we certainly put our hand up as well. So lots covered, great topics. Hopefully we will do another one, though I'd really rather wait till we could all be together. I really can't wait to see your faces again and sit around with a glass of wine. But in between times, thanks for joining us, and thank you very much, Shane and Aintree, for putting on such a great presentation.
And thanks for having me. Really appreciate it. Thank you.
Great. Goodbye, everybody. See you next time.
Cheers.